Something shifted in the silver market this week. Not a rumor, not speculation. An actual measurable event that has traders, investors, and institutions all recalibrating their positions at the same time. If you hold silver, you felt it. If you've been watching from the sidelines, you've noticed. And if you're wondering whether this is the beginning of something larger or simply another chapter in a familiar story, you're not alone. This isn't about panic, it's about understanding. Because what happens next in the silver market won't be determined by headlines or social media posts. It will be determined by how well you understand what's actually taking place beneath the surface. Let me be direct. Silver experienced a sharp, sudden decline that caught many off guard. Prices that seemed stable days ago have dropped in a way that feels abrupt, even violent to those watching their portfolios. The word freefall isn't hyperbole when you look at the charts, it's description. But here's what matters more than the drop itself. Why it happened, what it reveals about the current market structure, and what it means for anyone holding this asset or considering it as part of their financial strategy going forward. This video isn't here to tell you what to do with your money. That's your decision and yours alone. What I can offer is context, clarity, and a framework for thinking through moments like this without letting emotion or noise drive your choices. Let's talk about what's really happening. Silver has always occupied a unique space in financial markets. It's both an industrial metal and a monetary asset. It's accessible to everyday investors, but also traded by massive institutions. It moves with gold sometimes, diverges other times, and occasionally does things that seem disconnected from everything else. The dual nature makes it fascinating. It also makes it volatile. When silver drops sharply, it doesn't just affect traders. It affects people who bought physical coins or bars as insurance. It affects miners and mining stocks. It affects industrial users who need the metal for manufacturing. And it affects the psychology of millions of investors who have been told for years that silver was undervalued, suppressed, or about to explode. So when the opposite happens, when silver falls hard and fast, it creates confusion. People start asking, was I wrong? Did I miss something? Is this the end of the precious metals thesis entirely? These are reasonable questions. They deserve thoughtful answers, not quick reactions. What makes this particular moment significant isn't just the size of the drop, it's the timing. It's happening at a point where global debt levels remain historically elevated, where currency pressures are mounting in various regions, where inflation data continues to puzzle central banks, and where geopolitical tensions haven't subsided. In other words, this is happening in an environment where many investors expected silver to do the opposite. They expected it to hold firm or rally. Instead, it's doing what markets often do, the unexpected. Understanding why requires looking beyond the price chart. It requires examining the forces that move capital, the mechanics of commodity markets, and the human psychology that drives buying and selling decisions under pressure. That's what we're here to do. Let's establish the facts without embellishment. Silver's price declined sharply over a compressed time frame. We're talking about a percentage move that in traditional equity markets would be considered severe. For a commodity that many view as a store of value, the speed and magnitude of the decline triggered widespread attention. The move wasn't contained to futures markets alone. Physical premiums shifted. Mining stocks dropped in sympathy. Exchange-traded products saw unusual volume. The entire silver complex responded in unison, which tells us this wasn't an isolated glitch or technical error. Volume patterns suggest this was genuine selling pressure, not simply a lack of buyers. Someone, or more likely many participants simultaneously, decided to exit positions. Whether that decision was voluntary, forced by margin calls, or driven by algorithmic trading systems doesn't change the outcome. The selling happened and prices adjusted accordingly. What's notable is how quickly the decline occurred. Markets that fall slowly give participants time to think, to adjust, to make calculated decisions. Markets that fall quickly force decisions. They create urgency. They trigger automated stops. They generate momentum that feeds on itself. This is where things get interesting from an analytical standpoint. When an asset falls sharply, the immediate impulse is to ask, what bad news came out? What changed fundamentally to justify this move? And often, the answer is nothing obvious. No major mine collapsed. No government banned silver ownership. No breakthrough technology eliminated industrial demand. That absence of clear negative news actually tells us something important. It suggests the move was more about positioning, leverage, and market structure than about fundamental changes to silver's long-term role in the economy. Think of it this way. If a stock drops 20% because the company announced bankruptcy, that's a fundamental story. If it drops 20% because hedge funds unwound a crowded trade, that's a technical story. Both create the same price result, but they mean very different things for what happens next. Silver's recent decline appears to be more technical than fundamental. That distinction matters enormously for how you should think about it. Here's what most market commentary won't tell you, because it requires understanding how modern commodity markets actually function behind the scenes. Silver trades in multiple venues simultaneously. There's the physical market, where actual metal changes hands. There's the futures market, where contracts representing future delivery are bought and sold. There's the options market, layered on top of futures. And there are various financial products that claim to track silver's price without necessarily holding much physical metal at all. These markets are connected, but they're not the same thing, and they don't always move in perfect harmony. When large institutional players need to adjust their positions quickly, they often do it in the most liquid venue, futures. A massive sell order in futures can move the price dramatically in minutes. That price movement then ripples through to other venues, creating the appearance of unified selling pressure even if the physical market itself remains relatively stable. This is where leverage enters the picture. Commodity futures allow traders to control large positions with relatively small amounts of capital. That magnification works beautifully when prices move in your favor. It works devastatingly when they don't. A 10% move against a highly leveraged position can wipe out an account entirely, forcing liquidation regardless of long-term outlook. Now multiply that dynamic across hundreds or thousands of traders, all using similar strategies, all getting margin calls at similar price levels, and you create what's called a cascading liquidation event. Selling begets more selling, not because anyone's fundamental view changed, but because the market structure itself creates a forced sequence of events. Does this mean silver is manipulated? That word gets thrown around constantly, and it muddies more than it clarifies. Are markets influenced by large players? Yes, always have been. Does high-frequency trading create strange price movements? Absolutely. Do concentrated positions by banks and funds affect price discovery? Without question. But calling it manipulation implies a level of control and coordination that probably doesn't exist in the way people imagine. What actually happens is more mundane and more complex. Different participants with different time horizons and different risk tolerances, all acting in their own interest, creating emergent patterns that no single entity orchestrated. The silver market is thin compared to currency or bond markets. It doesn't take as much capital to move it. That's both an opportunity and a risk, depending on which side of the trade you're on. If you followed precious metals for any length of time, this isn't your first sharp decline. It won't be your last. Silver has a documented history of violent moves in both directions. It's crashed before. It's surged before. It's spent long periods doing almost nothing, frustrating everyone who holds it. In 2011, silver briefly touched $50 per ounce, then proceeded to lose nearly 70% of its value over the following years. People who bought near the top endured almost a decade of losses. People who bought near the bottom in 2015 and 2016 saw their positions eventually recover and profit. The lesson isn't that timing is everything, though timing certainly matters. The lesson is that silver moves in cycles, and those cycles are longer and more brutal than most investors anticipate. Why do these cycles exist? Because silver responds to multiple inputs that don't always align. As an industrial metal, silver tracks economic growth expectations. When manufacturing contracts, industrial demand softens, putting downward pressure on prices. As a monetary asset, silver responds to currency concerns, inflation fears, and loss of confidence in financial institutions. When those fears intensify, silver often rallies. When they fade, it gives back gains. As a speculative vehicle, silver attracts momentum traders who pile in during rallies and flee during declines, amplifying moves in both directions. These three forces rarely push in the same direction simultaneously. Most of the time, they're in tension, which is why silver can seem directionless for extended periods. Understanding cycles means accepting that assets don't move in straight lines. It means recognizing that corrections, even severe ones, are normal features of bull markets. And it means having the emotional discipline to distinguish between a correction within an ongoing trend and a trend reversal itself. How do you tell the difference? You can't, not with certainty, not in real time. What you can do is look at longer time frames, examine the fundamentals that initially attracted you to the asset, and ask whether those fundamentals have changed. Has global debt suddenly become manageable? Have central banks committed a sustainable fiscal policy? Have governments stopped printing currency? Has the industrial demand case for silver evaporated? If the answers are no, then what you're witnessing might be painful, but not necessarily the end of the story. This doesn't mean prices will recover quickly. Markets can stay irrational or depressed far longer than seems reasonable. But it does suggest that writing off silver entirely based on one sharp move might be premature. Let's talk about how people actually behave when their investments drop sharply, because this is where most damage gets done. When silver was rising, or even just holding steady, it was easy to feel confident. You told yourself you understood the thesis. You believed in the fundamentals. You planned to hold for the long term no matter what. Then the crash happens, and suddenly those convictions feel shaky. You see your account value drop by double digits in days. You read headlines about silver collapsing. You see other investors panicking on social media. And a voice in your head starts asking, what if I'm wrong about everything? This is the moment that separates disciplined investors from everyone else. Disciplined investors anticipated this possibility. They didn't know when it would happen or how severe it would be, but they knew that volatility was part of the deal with silver. They sized their positions accordingly. They didn't invest money they couldn't afford to see decline. And most importantly, they made decisions about their exit strategy before emotions were running high. Everyone else is making decisions in real time, while stressed, while watching losses accumulate, while surrounded by conflicting opinions and urgent-sounding advice. The psychological trap is thinking that because something has fallen, it must fall further. Or conversely, thinking that because you're down significantly, you should average down aggressively to make back losses faster. Both instincts are dangerous. Markets don't care what price you paid. They don't care about your cost basis or your emotional attachment to being right. They simply reflect the current aggregate opinion of all participants about what something is worth right now. When you're holding an asset through a decline, your job isn't to predict the bottom or to outsmart the market. Your job is to continually reassess whether your original thesis still makes sense given new information. If the thesis is broken, if something fundamental changed that invalidates your reason for holding, then price becomes less relevant. You should probably exit regardless of whether you're at a gain or loss. If the thesis remains intact and the decline appears technical or sentiment-driven rather than fundamental, then panic selling locks in losses and removes you from potential recovery. The hard part is being honest with yourself about which situation you're in. Let's zoom out and examine the larger economic environment because silver doesn't trade in a vacuum. The global economy remains in an unusual state. We're years past the initial pandemic disruptions, yet many of the emergency monetary policies haven't been fully unwound. Central banks accumulated massive amounts of government debt. Money supply expanded dramatically. And now as they attempt to normalize policy, they're discovering that normalization itself creates problems. Interest rates rose significantly from historic lows, which was intended to combat inflation. That rate increase had predictable effects. Borrowing became more expensive, asset valuations adjusted downward, and economic growth slowed in various sectors. For silver, higher interest rates create a headwind. Unlike bonds or deposits, silver doesn't pay yield. When safe government debt offers 5% returns, silver needs a strong alternative reason to justify holding it. The insurance argument still exists, but it competes against guaranteed returns elsewhere. At the same time, inflation hasn't disappeared. It moderated from peaks, but prices remain elevated across many categories. Wage growth continues in certain sectors. Housing costs persist at high levels. The idea that inflation is fully defeated and we're returning to the pre-2020 economic regime seems optimistic. This creates tension. Silver historically performs well in high inflation environments, yet it's dropping in an environment where inflation concerns haven't vanished. That seeming contradiction confuses people. The explanation lies in expectations rather than current reality. Markets are forward-looking. If enough participants believe inflation will continue declining, they'll position accordingly now, even if inflation remains elevated today. If they believe central banks will cut rates in the near future, they'll adjust positions in anticipation. Silver's decline might be telling us that market consensus currently expects disinflation, rate cuts, and economic stabilization. Whether that consensus proves correct is another matter entirely. Currency dynamics add another layer. The US dollar strengthened recently against many other currencies. When the dollar rises, dollar-denominated commodities often face pressure because they become more expensive for foreign buyers. That's a technical relationship, not a fundamental one, but it influences price action significantly. Geopolitical factors remain in play as well, though they are unpredictable. Tensions in various regions, trade disputes, and shifting alliances all create uncertainty. Uncertainty sometimes benefits precious metals as safe havens. Other times, it creates general risk aversion that affects everything simultaneously. Trying to predict how all these forces will interact is essentially impossible. What you can do is understand them, recognize that they exist, and accept that commodity prices will fluctuate as markets process new information and adjust expectations continuously. If you already own silver, whether physical metal or positions in other forms, this decline has likely tested your resolve. First, acknowledge the reality of where things stand. Your position is down from where it was. That's not pleasant, but denying it or pretending it doesn't matter won't help you make good decisions going forward. The question now is whether your reason for holding silver has changed. Did you buy silver as portfolio insurance against currency debasement or financial instability? If so, has that risk disappeared? Most would argue it hasn't. In that case, short-term price movements, while painful, don't necessarily invalidate the insurance function. Did you buy silver expecting quick profits based on momentum or promotional content, suggesting imminent price explosions? If so, this decline is a harsh lesson in the difference between speculation and investment. You might need to reconsider whether silver fits your actual strategy. Did you buy silver as part of a diversified approach, Sizing the position appropriately so that even a 50% decline wouldn't devastate your overall financial picture? If so, this is simply volatility doing what it does. Uncomfortable, but not catastrophic. Your path forward depends on which category you're in. For those holding physical silver for insurance purposes, the calculus is different than for those holding paper positions for speculation. Physical metal has no margin calls, no expiration dates, no counterparty risk. It sits there, its price fluctuates, but you don't have to do anything unless you choose to. The psychological challenge is maintaining conviction during periods when the market seems to be telling you you're wrong. Remember that markets can be wrong for extended periods, especially in assets that aren't directly tied to corporate earnings or economic output. If you're overextended, if holding through this decline is causing genuine financial stress, then reducing position size to a level you can hold comfortably through further volatility might be wise. There's no shame in recognizing that you miscalculated your risk tolerance. Better to adjust now than to be forced out at an even worse moment later. If you're positioned appropriately and your thesis remains intact, then the disciplined approach is to do nothing. Not because doing nothing is always right, but because reactive trading during volatile periods usually compounds problems rather than solving them. If you don't currently own silver but have been interested, this decline changes the equation in specific ways. Price is lower now than it was weeks ago. From a pure cost perspective, you can acquire more ounces for the same dollar amount. That's arithmetic, not analysis. But cheaper doesn't automatically mean better. Things can get cheaper for good reasons. The relevant questions are these. Do you understand why you're considering silver? Can you articulate the case for holding it in a way that makes sense, regardless of short-term price action? Are you prepared for further declines before any potential recovery? If your interest in silver is primarily because it dropped and you think it might bounce quickly, you're speculating on short-term momentum. That's a valid trading strategy, but recognize it for what it is. It requires different skills and temperament than investing. If your interest stems from concern about long-term monetary policy, currency stability, or the desire for assets outside the financial system, then silver's recent decline might represent an entry opportunity. But only if you're genuinely committed to holding through volatility and not panicking if it drops further. One thing this decline has done is remind everyone that silver is not a stable asset. It's not a substitute for emergency savings or short-term funds. It moves, violently sometimes. Anyone allocating money to silver needs to accept that reality completely. The advantage of entering after a sharp decline is that some of the euphoria and overvaluation has been wrung out. The disadvantage is that declines can continue well past the point where they seem overdone. Trying to perfectly time a bottom is nearly impossible. If you're considering building a position, doing so gradually rather than all at once reduces timing risk. It also forces discipline by preventing you from committing everything based on one moment's conviction. Remember that silver is volatile in both directions. What fell quickly can also rise quickly, but it can also chop sideways for years. Your strategy needs to work in all three scenarios. Let's be explicit about behaviors that will almost certainly make your situation worse, regardless of what happens next with silver prices. Do not panic sell after a major decline. If you're going to exit, do it because your thesis changed, or you recognize you were overextended, not because seeing red numbers triggered an emotional response. Panic selling locks in maximum loss and removes you from any potential recovery. Do not dramatically increase your position to average down losses unless you have genuinely new capital you're comfortable risking. Using existing funds from other areas of your portfolio, or worse, borrowing money to buy more silver, turns one mistake into a potentially catastrophic series of mistakes. Do not chase the next hot tip or urgent-sounding YouTube video promising that silver is about to reverse. People make content during volatile periods because that's when viewership spikes. Much of that content is designed to generate clicks, not to help you make sound decisions. Do not trade frantically, moving in and out of positions in response to daily price movements. Every trade costs money in spreads, fees, or premiums. Hyperactive trading during volatile periods usually enriches brokers and dealers while depleting your capital. Do not convince yourself that you know exactly what happens next. Nobody does. The future is probability, not certainty. Making large, concentrated bets based on confidence in a specific outcome is gambling, not investing. Do not ignore the rest of your financial life because you're fixated on silver. Whether silver recovers or falls further, you still need emergency savings, you still need to manage debt, you still need appropriate insurance. Don't sacrifice fundamental financial health chasing commodity returns. Do not blame others for your losses. Yes, you might have heard bullish arguments from analysts or content creators, but you made the decision to allocate your capital. Own it, learn from it, use it to make better decisions going forward. Do not isolate yourself in echo chambers where everyone holds the same position and reassures each other that everything will be fine. Seek out different perspectives. Challenge your own assumptions. Be willing to change your mind if evidence warrants it. Avoiding these behaviors won't guarantee profit, but it will prevent you from turning a manageable situation into a disaster. The investors who navigate volatile markets successfully don't do so because they predict the future better than everyone else. They do so because they manage risk better and make fewer emotional mistakes. When facing a situation like silver's recent decline, disciplined investors start with assessment, not action. They review their original investment thesis. They look at what's changed in the fundamental landscape. They consider whether the decline reveals information they previously didn't have, or confirms risks they already understood. They think in terms of scenarios rather than predictions. Instead of committing to a belief that silver will definitely do X, they consider multiple possibilities: recovery, further decline, extended sideways movement. Then they ask themselves whether their current position allows them to weather all those scenarios without making decisions they'll regret. They consider opportunity cost explicitly. Money in silver is money not in other assets. Even if silver eventually recovers, if another investment would grow faster during the same period, holding silver has a cost. That doesn't mean constantly chasing whatever's working right now, but it means periodically reassessing whether your allocation still makes sense. They avoid the sunk cost fallacy. The money you've already lost is gone. It's irrelevant to what you should do now. The only question that matters is, given where things stand today, is this the best use of your capital going forward? If not, previous losses shouldn't prevent you from making changes. They maintain humility about what they know and what they don't. Markets are complex adaptive systems. Unexpected things happen constantly. Being right on analysis doesn't guarantee being right on outcome, because timing and path matter enormously. They understand that being early is often indistinguishable from being wrong. Even if silver eventually vindicates the bullish thesis, if that takes 5 years and requires enduring a 50% drawdown, many investors won't survive the journey psychologically. Sometimes recognizing that you don't have the temperament for a particular investment, even if the investment itself is sound, is the wisest decision you can make. Most importantly, disciplined investors remember that this is one decision among thousands they'll make over a lifetime of managing money. No single trade, no single asset, no single outcome determines ultimate success or failure. What matters is the accumulated effect of making more good decisions than bad ones, controlling risk consistently, and learning from mistakes without repeating them. Silver will do whatever silver does. You can't control that. You can only control your response to it. If you're holding silver, ensure your position size allows you to sleep at night regardless of further price movement. If it doesn't, adjust it. Pride isn't worth financial stress or impaired decision-making. If you're considering silver, take time to genuinely understand both the potential benefits and the very real risks. Don't buy based on others' conviction. Develop your own based on research and honest assessment of your goals and risk tolerance. Watch for changes in the fundamental picture. Are governments committing to fiscal responsibility? Are central banks reducing their balance sheets sustainably? Is inflation genuinely defeated? Are currency stresses resolving? These questions matter more than daily price fluctuations. Stay informed, but be selective about information sources. Prioritize analysis over emotion, data over anecdotes, historical context over immediate reactions. The financial media landscape is designed to capture attention, not necessarily to foster wisdom. Remember that volatility creates opportunity for those who can remain calm while others panic. It also destroys capital for those who react impulsively. Which category you fall into depends entirely on preparation and temperament. Consider silver in the context of your entire financial life, not as an isolated bet. It might be a reasonable portfolio component for some people, an appropriate size with realistic expectations. It's not a miracle solution or a guaranteed path to wealth. Silver's recent decline is dramatic, unsettling, and exactly the kind of event that tests whether you're genuinely an investor or just someone temporarily holding an asset during the easy times. Market corrections separate preparation from hope, discipline from impulse, long-term thinking from short-term reactivity. This isn't the first time silver has fallen sharply. It won't be the last. The asset's volatility is feature, not bug. It's the price you pay for the potential benefits silver offers in specific scenarios. What matters now isn't predicting where price goes next week or next month. What matters is understanding your own position, your own goals, your own risk tolerance, and then making decisions that align with those realities, not with what you wish were true or what others tell you to do. The truth about investing is that nobody can spare you from uncertainty. Anyone claiming they can is selling something. What you can control is how thoroughly you understand what you own, why you own it, and what you'll do in various scenarios. Silver's fundamentals haven't changed because price dropped. Global debt still exists, currency pressures still exist, industrial demand still exists. What changed is market sentiment, positioning, and short-term supply-demand dynamics in derivative markets. Whether that price decline represents temporary dislocation or the beginning of a longer downtrend remains to be seen. You don't need to know which it is to make sound decisions. You only need to be honest with yourself about what you know, what you don't, and what you're comfortable with. The investors who navigate periods like this successfully aren't the ones who never experience losses. They're the ones who experience losses without being destroyed by them, who learn from volatility without being paralyzed by it, and who maintain perspective when others are losing theirs. This is a moment for clarity, not panic, for assessment, not reaction, for discipline, not emotion. Whatever you decide about silver going forward, make that decision from a place of understanding and calm, not from fear or urgency. That's how you protect capital. That's how you preserve the ability to recognize genuine opportunities. And that's how you build an investment approach that endures regardless of what any single asset does in any single period. The crisis isn't in the price chart. The crisis is in reacting to the price chart without understanding what you're looking at and why it matters. Stay informed, stay disciplined. And remember that navigating financial markets successfully is a marathon, not a sprint. This is 1 mile among many. Keep perspective, manage risk, and focus on what you can control. That's how you move forward from here.